Yes, I can hear you.
Yes,
Wale.
can you just talk us through why we're seeing more interest in shorter dated instruments, treasury bills, as opposed to the longer dated?
I think basically what has happened in the market is that the general sentiment has changed for investors, because if you look at treasury bills currently where they are trading, coming from about 30% discount rate to about 11% as at last week. If you look at a discount rate of, say, what, 12.4%, the effective yield on that bond will probably, on that bill, I mean, will probably be touching about 13.1%. So for an investor right now, would rather place your money in a one-year treasury bill giving you a 13.1% yield as against a 5-year instrument that is also giving you a 13.05% yield. So I think for investors, they're just basically trading at the shorter end of the curve because the return on it is equally significant as compared to the longer end of the curve.
Okay, so we're seeing the first OMO auction in a pretty long time. Of course, we know the reasons why. There's been less need to do that, given the massive withdrawal of funds as a result of that MPC decision to increase the cash reserve ratio for public sector deposits. So can you just talk us through, for you, the key takeaways from that first OMO auction?
I think what happened on Friday with the CBN coming on board to issue about 90 billion of 132-day treasury bills in the market at about 12.75%. You want to look at the FX market, because what happened last week was that we saw the FX market trading at an all-year high at 163.60-70, and we saw some form of CBN intervention on Friday. So I think the CBN coming in with the OMO at that point was an offshoot of what was happening on the FX side of things. So it's basically just to strike out a balance, as it were, on the FX side. Because I mean, if there's some form of tightening in the market, theoretically speaking, yield should go up on the longer end of the curve. I mean, you should have banks and investors selling down their positions, and yields typically going up, which should naturally attract the foreign investors. And with inflows coming in from foreign investors, it will provide some short form, I mean in the medium term, some form of stability to the Naira.
How low do you think these T-bill yields could go, in your view? Where do you think they're likely to settle? We know that 3 to 10-year bonds really at about 13 to 13.5%. So what, in terms of where the T-bill yields would settle, what are your thoughts?
Sorry, Wale, I didn't get your question.
I want to get your thoughts on the outlook for T-bill yields, looking at 1 year and tenors less than a year. Where do you think the yields for those securities are likely to trade going forward?
Okay, two scenarios. I'll look at two scenarios. If the CBN continues with the OMO auctions, you might typically see treasury bills trading at about 12.5 to 12.8 levels, round about the auction stop rate. However, if that is not the case, if the CBN stops issuing the OMO auction, then you might probably see treasury bills dropping as low as 11.5 or sub 11.5 on the longer end of the curve. So it depends on how much supply we have hitting the system.
All right, so the T-bill yields, rather the OMO auctions will have a significant part to play in where T-bill yields end up. Thank you so much for joining us, Yobosa from Don Merrifield, talking us through the Nigerian fixed income market, and that's where we leave it from the Closing Bell West Africa team for today. Remember to email us on closingbell@abn360.com. Follow us on Twitter @theclosingbell. After the break is Beyond Markets with Nozipo Mbadra.